Welcome everyone to the first discussion video for Chapter 8, all about budgeting. But before we get going on new material, I wanted to hit a couple more review type problems. The first one is shown here. Your firm sells one product priced at $30. It has total variable cost per unit of $10, and your firm's total fixed costs per period are $200,000. Let's say your firm's currently selling 15,000 units per period. What's the current break-even point in units sold? And then under this current cost structure, which of the following independent changes would have a bigger impact on the break-even point? Increasing the price to $35 with everything else unchanged, or decreasing fixed costs by $20,000, again with everything else unchanged. So pause this, work through that, and then come back for the solution. So our answer there is B. So let's find the break-even point first. One way we find the break-even point in terms of units is to take the total fixed cost for the period divided by the unit contribution margin for the product being sold. Unit CM, a good representation of how much every unit I sell contributes toward bottom line potential profit. So the unit CM in this case is the price of $30 minus the total variable cost per unit of 10 or $20. If I take the fixed cost then of $200,000 per period, divided by that unit CM of 20, my break-even point's 10,000 units. Now, if I increase the price of this product to $35 with nothing else changed, my new break-even point would be the fixed cost of $200,000 divided by the new unit contribution margin of $25. Okay, that new $5 price increases the unit CM by $5 as well. So the break-even point under that change would be 8,000 units. If instead I was able to decrease fixed costs by 20,000, my new break-even point would be the 200,000 in fixed cost minus 20,000, so 180,000, divided by that original unit CM of $20 for a break-even point of 9,000 units. So the biggest impact would be that price increase. It would move break even from 10,000 units to 8,000 units rather than 10 to 9. All right, next up, under which costing system could some non-manufacturing costs be included in unit product costs? Give that some thought, pause here, and then come back for the solution. So that would be C under our activity-based costing, or ABC. That's from Chapter 7. So recall the big differences with ABC and our traditional costing systems are that under ABC we have some non-manufacturing costs potentially included in unit product cost, things like our direct selling costs. Also the difference under ABC, we may have some of our manufacturing costs that don't get included in unit product cost. Whereas under our traditional costing systems, all those manufacturing costs and none of the non-manufacturing costs get included as product costs. All right, so that brings us to our new material here, Chapter 8, Master Budgeting. Our first learning objective is to understand why organizations budget and the processes they use to do that stuff. So a budget for our purposes is really just a plan, and it's a quantitative plan for getting a hold of any resources we need, be it financial or otherwise, to support operations for an upcoming time period. You may hear or have heard even in the past tense, people refer to the dual purpose nature of budgets. And what that means is budgets can be used for planning, as we often naturally think of them for, but also for control. So if we're talking about using budgets for planning, we're talking about using budgets to develop objectives, put together the quantitative, again, plans to achieve those objectives. If we're using budgets for control, we're talking about using budgets to gauge our actual performance versus our planned or expected performance to see how we did and then adjust accordingly. So all the steps that we then take to improve going forward. So budgets are often used for, of course, planning, but also for control, this performance evaluation, in other words. Now, there are a whole bunch of benefits of budgeting, and this would extend, I think, even to sort of personal budgets, but we'll stick in the organizational context for now. So they give us a way to define our goals and objectives, and they give us a way to think about and plan for the future related to those objectives. help us start to figure out how we're going to reach those goals. Now, they also help us communicate our plans throughout the organization, try to get everyone on the same page to reach the same objectives. And related to that, they help us coordinate activities from one part of the organization to the next. Again, if everyone understands how their piece of the operation fits into our overall goals and objectives and the quantification of that, we'll have a better likelihood of achieving those objectives. Now, they also help us, related to those previous two things, allocate resources within the organization. Again, if we're going to individual managers and saying, here's how your part of the operation fits in with our overall organization-wide objectives, it's also going to tell them what they need to do in terms of securing labor and capital and all those other types of resources to start working toward those objectives. Now, I'll sort of, with my cursor here, highlight these two things together. It helps us evaluate performance if we use our budgets for that control function we spoke of a minute ago. And directly related to that would help us potentially uncover bottlenecks in our processes, or at least areas where there is more room for improvement than others. Now, one term introduced here in Chapter 8 is this idea of responsibility accounting. And we've alluded to this at various times throughout previous chapters, but we sort of formalize it here in Chapter 8. Responsibility accounting just says that managers should really only be held responsible for those items they can have some kind of significant control over. So using an approach of responsibility accounting does help organizations react more quickly to deviations from these plans, these budgets, and to learn from that feedback. Quick sidebar then, what's one other concept or tool or principle that we've studied this semester that fits perfectly in line with this idea of responsibility accounting? Think about that for a second and then pause and come back for a potential solution. Yeah, there are multiple answers here, but segment reporting and that notion of traceability of costs is probably sort of the best fit. If you think about Chapter 6 and our segmented reporting information, we said, hey, we don't want to hold individual divisions or segment responsible for things that were outside their control, all these common costs of the organization. So we introduced that idea of traceable fixed costs to a particular division. That fits perfectly in line with this idea of responsibility accounting. For any budget activity, we have to pick a budget period. Now, a lot of operating budgets do span 1 year. A lot of times, though, now organizations are doing continuous budgeting. And all that means is that we're always looking, 6 months or a year, or sometimes even just a quarter into the future. And as one period rolls off the front end and we pass it, so to speak, we're adding another one onto the back end. So this has certainly been made more possible by big data and some of the analytics tools and processes that have become very, very popular in management reporting. Now, there are many different tacks that organizations can and do take with regard to budgeting processes. Two sort of fundamental approaches are top-down or bottom-up budgets. Now, a self-imposed or participative or bottom-up budget is one that's prepared with the full cooperation and really input, if you will, of managers at all levels. So in participative budgeting, usually what happens is organizations start with the lowest level managers, these direct sort of supervisors and production managers in that type of role, and asks them or tasks them with putting together their budget for an upcoming period. Then those lowest level budgets would be rolled up and aggregated to the next level, and the next level, and the next level, and the next level, until we reach sort of a top organization-wide view. And then the executives of the firm would kind of get together and look at that and see if all those estimates seem reasonable, if those objectives fit with their strategic vision for the firm, and things like that. But participative budgeting, we can think of as bottom-up budgeting or self-imposed budgeting. So there are several advantages or potential benefits of using this participative budgeting approach. First, individuals at all levels of the organization really do feel like they are members of the team to a greater extent, right? They're sort of empowered with this decision-making capability. Now, related to that, the estimates coming from those lowest level managers should be more accurate than estimates that are pushed down from the top of the organization. right? These are the folks that have the best knowledge of how their part of the organization runs, what it takes for them in terms of resources to execute their plans. So those estimates, again, should be the most accurate. Now, motivation is generally higher when individuals participate in setting their own goals rather than when those goals are imposed from others or from above in the organizational context. And that really extends beyond the budgeting setting to kind of everything. When you think about just kind of how you'd feel about it yourself, if someone asking you to set your own goal, you probably are going to feel like that's a more fair process than if someone comes and imposes a goal for you. Now, related to that, a manager who's not able to meet their budget targets, if those are imposed from above, can claim that the goal was unrealistic, it was unfair. If they're setting that goal themselves, that's a little bit less tenable of an excuse, right? It's like, well, you had the best information about it, you set your own goal, what happened? It's a lot easier to kind of address that versus if those goals are set from someone else. Now, we do have to be careful here. Self-imposed budgets should be reviewed by higher levels of management to prevent slack. It's really just an oversight process. Slack is certainly a concern. If you think about if someone came to you and said, what grades do you think you'll have for the upcoming semester? What do you think your GPA will be? You're probably not going to set that at 4.0, right? Even if you think you can get a 4.0, and you have in the past and you think you can do it again or whatever, you're probably not going to say 4.0 because you don't leave yourself any room for any kind of things that don't go exactly as planned, right? Same idea in a budget setting. If you go to a manager and say, what are the total resources you need to run your operations, they're not going to want to give you the bare bones minimum, right? You want to build in a little bit of cushion for some unexpected events or some things that just kind of don't quite go right. So a lot of companies issue broad guidelines in terms of overall profits and then expect lower level managers to kind of put their budgets together in a way that would meet those targets or collectively meet those targets within a division or within a segment and so on. One other thing I'd point out real quick here, there's a whole bunch of research in management accounting on the use of budgetary slack, what causes people to build in more or less of it, what organizations can do to minimize it. I've put some papers out there. Fisher et al. 2002, 3, and 5. Douthit and Stevens 2015. They've been posted in our files section of Canvas under that accounting research folder. If you're curious, I encourage you to take a look there. Now, as with a lot of the things we've discussed in this class, the success of a budget program depends on a whole bunch of human factors. So first is that top management has to be committed to the budget process. They have to be enthusiastic about it. They have to stress its importance. Second, top management must not use that budget to pressure employees or strictly to blame them when something goes wrong. Now, you may be kind of thinking, well, if we're not going to use them to kind of look for faults or look for areas of improvement, what's the purpose of using them for control? And there's a very fine line we're kind of sitting on here in terms of using budgets to improve, to get better, versus just to blame and kind of use them as a punitive thing. And fitting with that, number 3, typically if managers are being rewarded based on meeting budget targets, we want to have some kind of highly achievable target or goal. We don't want to have sort of targets that are impossible for anyone to hit. Now, research would suggest that the best return of effort comes from quote unquote medium difficulty targets. Things that people have to work pretty hard to reach, but not so hard that they think it's impossible before they even start. And there's some research in accounting on this as well. I put a paper out there in that research folder, Sprinkle et al. 2008, that looks at the effects of these things on effort and risk taking. So that brings us to the master budget. And I love this picture. I know there's a lot of arrows and a lot of things flying around and a lot of pieces, but I think it does a nice job of sort of just showing this overall flow of the master budget. Now, at the very start here is the sales budget. Everything we do is driven off that. We have to be able to project or estimate what demand and sales will be for our products and services in order to budget for the resources that can deliver those products or services. That's why the sales budget kicks everything off here. This is at the start. So from that, we could develop our selling and admin budget. We'd also develop, if we think about a manufacturing context, a production budget. What do we have to make in order to fill all those orders, essentially? And because of that, then everything for our inputs would follow. What do we need in terms of materials, labor, overhead? Then what do we need to do in terms of our cash flows? And at the bottom here, really the outputs of this master budget process are the budgeted income statement and the budgeted balance sheet. We're trying to essentially say, given what we're projecting here in terms of our demand and all the resources we need to support that, what will that leave us in terms of a financial position, the budgeted balance sheet, and in terms of potential profitability, the budgeted income statement. So as is with most things in accounting, a master budget is based on a whole bunch of estimates and assumptions. And just as an example, the sales budget that we'll look at first needs at least 3 assumptions or estimates. And those are, what are the budgeted unit sales for thinking about a single product? What are we going to sell that thing for? And then what percent of accounts receivable will be collected in the current and subsequent periods? What are the timing of those cash flows related to sales? So that's learning objective 2 here. Prepare a sales budget including a schedule of expected cash collections. So let's use Royal Company for our budget examples here. Let's say they're putting budgets together for the quarter end June 30th. So that's April, May, and June. Let's say they've got budget sales for the next 5 months: April 20,000, May 50, June 30, July 25,000, and August 15,000. Let's assume this is just one product we're selling and that the selling price is $10 per unit. So the sales budget for that second quarter should just show, what do we expect to do in terms of the unit sales? What's the price we're going to sell that thing for? And then what's the total budgeted sales dollars for that entire period? And we'd probably lay it out just like it's shown here. Here's a column for April, one for May, one for June, and then one for the quarter as a whole. We're showing that sales volume, the selling price per unit, and then the total budgeted sales dollars for the same period. And then in that quarter column, we're just getting an aggregate of all those months put together. One quick thing worth noting, if we projected price increases, which is happening with everything right now in the world, we could build that into the budget. Right? If we expected a price hike in May to $13 a unit, we just build that right into the budget. Okay. Let's think about the timing of cash collections. Let's assume for Royal that all their sales are on account. So I have a whole bunch of accounts receivable. Everyone buys on credit. And let's assume their collection pattern is 70% of all sales collected in the month of sale, 30% the month after. So nobody is uncollectible. No one fails to pay. In April, let's assume that the March 31st accounts receivable balance of $30,000 would be collected in full in that month. So to put together an expected cash collection schedule, we might lay it out in a sort of columnar approach, just like our budget. So we might show the collections from each source. In other words, accounts receivable collected from the previous month in any particular month. Then we'd want to show every month's sales within that period. So here we had April sales of $200,000 in total. We're taking that right from the sales budget. And then we're showing the timing of when the cash for those sales is being collected, based on our assumption that 70% is collected the month of the sale, 30% the month after. So here in April, we're saying, hey, I assume I'm collecting 70% of April sales of $200,000 or $140. I'm collecting the other 30% or $60,000 in May. And then I do the same for the other months. So May sales of $500,000, 70% collected in May, $350. 30% or $150,000 collected in June, the following month. And then finally, June sales, same thing, $300,000 in total, 70% assumed being collected in June, so $210,000. The other 30%, note that those are going to be assumed to be collected in July, which is outside of the time frame of this quarter, what we're looking at here on this schedule. So we wouldn't show that anywhere at the top here. What that would be, though, is at the end of June, the end of this quarter, our accounts receivable balance would be assumed to be 30% of June sales, 30% of 300,000 or 90,000, rolling over to the following quarter there. So scheduled cash collections here just shows, again, month to month and for this full quarter, what do we expect to collect in cash from sales? This will be useful for our cash budget later on down the road. Okay, learning objective 3 was to prepare a production budget. So that, of course, follows sales. We're going to need information from that sales budget, what we expect to sell in terms of product, to figure out what we have to make. And that's the production budget. So there's the flow there. We also want to make sure we have enough stuff on hand for ending inventory in case sales are greater than expected. You may want to have a cushion. So we want to make sure we budget for that as well. So let's say for Royal that management says, hey, we want to have ending inventory equal to 20% of the following month's budgeted or expected sales in units on hand. Let's assume on March 31st that 4,000 units were on hand, and let's see what the production budget would look like for Royal here. Again, we'll lay out the 3 months in the quarter, April, May, June. Then we've got the quarter as a whole. The top line is budgeted sales, again, coming directly from that sales budget. So we already had come up with that estimate as part of the sales budget. And now we're trying to determine, given what we expect to sell, how many units do we have to make to support that? So our first step then is to add to the total number of units we expect to sell in any particular month, our desired ending inventory. Now we said here that that was going to be 20% of the following month's expected sales. So in April, we're saying 20% of May sales, so 20% of 50,000 or 10,000 units should be on hand for some kind of cushion or buffer in case sales are greater than expected, right, or something like that. You never want to leave customers, without. So if we add those two numbers together, we get total needs. So we're saying, hey, I have to cover everything I'm going to sell, and I've got to cover everything that I want to have left over in this cushion of inventory. My total needs then for April, 30,000. But I'm not starting from zero. So from that, I'm going to deduct my beginning inventory. Now, in this case, we were told explicitly that for Royal, 4,000 units were on hand at March 31st. So I'm just pulling that forward here. If we didn't know that, though, we could make the assumption that this 20% rule was in effect. And at the end of March, then, we would have been budgeting to have 20% of April sales of 20,000 or 4,000 on hand. So beginning inventory 4,000 subtracted from our total needs of 30,000 means we've got to make 20,000 or 26,000, units in the month of April. And then we'll carry forward to the other months here. So for May, we've got the 50,000 in expected sales. We're going to add to that the 6,000 in desired ending inventory. That's 20% of June sales, so 20% of 30,000. There's our total needs then, 50 plus 6, 56,000. We'll deduct from it the beginning inventory, which is the same as the ending inventory from April, 10,000 pulled forward here. And there's our required production, 56 minus 10, or 46,000. And then same thing for June. 30,000 in expected sales, plus 20% of the following month, that's July's expected sales, 5,000 there. Added together gives us 35,000 for total needs, minus our beginning inventory, which was the ending inventory from May pulled forward of 6,000. And there's our production of 29,000 units. Now the quarter as a whole, just be a little careful there. We're going to sum across to get total expected sales, 100,000 units. But the desired ending inventory shouldn't be an aggregate of the 3 months. It should be the same point in time as the end of the last month, right? In other words, the end of this quarter is June 30th. The end of June is June 30th. So this 5,000, that's the same point in time. So we'll just pull that forward. So 100,000 plus 5,000 means total needs of 105. Minus beginning inventory, and again, that's not a summation, that's the same point in time as the beginning of the quarter, so we're pulling that forward from April here, 4,000, and that leaves us with total required production for the quarter of 101,000. All right, let's try one here. Douglas Corp plans to sell 24,000 units of product A during July, 30,000 during August. Sales of product A during June were 25,000 units. Past experience has shown that end of month inventory should equal 3,000 units plus 30% of the next month's sales. On June 30th, this requirement was met. Based on this, how many units of product A must be produced during the month of July? So pause this, work through that, and then come back for the solution here. And that would be D, 25,800 units. So we're going to start with sales, budget at 24,000 units. We're going to add to that the desired ending inventory, which we said was 3,000 units plus 30% of the next month's sales. So in this case, that's 3,000 plus 30% of the 30,000 expected during August in sales. That gives us total needs, 24 plus 12, or 36,000 units. We'll subtract from that the beginning inventory, and it said our rule requirement here was met. So that means we would have had 3,000 plus 30% of July sales of 24,000 on hand. 36,000 minus that beginning inventory gives us required production of 25,800 units. Okay, I'm going to stop there. Back up and review any part you need to. Let me know if you have any questions, and move on to the next video, which covers some of the other budget pieces.